Welcome back, folks, to Investor Diaries. We are continuing our home ownership series, and this is a brand new episode on the series. Now that we've covered the basics, we will start to look at some of the finer and more intricate details of mortgage. In today's video, we would like to specifically dive into home equity lines of credit and give a little more insights into that. So, Appy, why don't you kick it off and give our users a little more idea about what exactly is a home equity line of credit?
Yeah, so to begin with, it's credit. So let's look at what are the kind of credits available in the market today. So at a high level, we've broken it down into three. There are many, but we'll speak about three. First is a credit card. So that carries a very high interest rate, say to the tune of about 20%. The second is an unsecured line of credit from the bank. Uh, the interest rate that you get will be dependent on your credit score, but it is safe to say that it is going to be anywhere from say prime plus 1, 2, 3, 4, 5. It can even be prime plus 10% rate of interest, depending on how your credit score is and a bunch of other factors. And then eventually we have a secured line of credit. It's got the lowest interest rate. It could be at prime, it could be just above the prime rate of interest. It's usually tagged to a benchmark interest rate, which in Canada is the prime rate of interest. So why is this interest rate lowest in this case, Nidish?
Yeah, so that's a great question. And the reason a secured line of credit is low is because the bank has a collateral against it. So let's say, for example, a home equity line of credit, a bank has your home that is secured against the line of credit. And that's the reason it is lower risk. And hence, you're getting lower risk for the bank, you're getting a better interest rate simply for that. And Api mentioned about different types of credit. Those are the common credit types that is available in the market. And it's important to note here also that credit card interest rate, Api mentioned 20% of interest, but typically when you see on a credit card, it would be a low interest rate of 2% per month. So that's a key call out here because 2% per month is well over 20% interest in an annum. So just keep that in mind as well.
Okay, so that's great. Let's actually also try to look at why is HELOC so important, and HELOC is home equity line of credit.
Yeah. Yeah. So, like we said earlier, a HELOC is a secured form of credit. The lender uses your home as a guarantee or a collateral to provide you this line of credit. Now, why is it important? So, HELOC can be a great source of value for homeowners to access the cash for any other purpose. HELOCs are usually secured against your value of the home, so that way you benefit from a lower interest rate. So that's also another positive attribute to it. HELOC comes up as a lump sum of cash, and it's often with a fixed interest rate, like Abby mentioned earlier, prime plus 0.5. So let's say the prime rate today is 2%, you're going to get 2.5%. So you know for sure that it is at 2.5% up and until knowing the prime interest rate. So that's another attribute. And it is a revolving source of interest. So you need urgent cash. You need like $5,000 today for renovation, and in a month you're gonna get a bonus at work, and you're gonna get that liquidity infusion. You can pay back this loan of 5,000 at that point. So you only pay the interest for the period that you've been borrowing it.
Yeah, so really great points, Nidish. Can you quickly walk us through some of the most common use cases as to why I might actually need a HELOC?
Yeah, so essentially the ultimate premise is you need HELOC for wherever you need quick liquidity, right? So one use case is home improvements. Like I said, you need to repair your garage, or you need to put another bathroom, you need to do some renovations, you have quick cash available. Education can be another use case where you need to pay off your student um, debt or student line of credit, assuming that is at a higher interest rate than your HELOC, right? Debt consolidation, you have credit card debt, which, like we mentioned earlier, it's at 20% and above rate of interest per annum. You can use the money from your HELOC and consolidate that. You want to maybe start a side hustle or a business, right? Like maybe you want to start a YouTube channel and you want to purchase some equipment on that, right? So you can use the money from HELOC, a low rate of interest on that. And the last but not the least, you have a quick medical emergency, and we are all living through tough times, right? You have a quick medical emergency, you need a surplus of cash, and you don't have that with you at this point. You can borrow money from HELOC. I hope nobody has to use this option, but it is an option out there that we need to discuss and mention.
Yeah, I think all of these were great use cases. I'm sure there are several other use cases as well. Um, so, Nitish, we've also heard that there are two main types of lines of credit in this.
Yeah.
Can you also talk to us about that?
Yeah, so there are two main lines of credit. One is a home equity line of credit that is combined with a mortgage, and the other one could be a standalone mortgage. Now, typically, the more common product in the market is the one that is combined with a mortgage. So, your mortgage is the collateral that the bank has, and the bank will provide your revolving line of credit against the principal that you paid up to a certain amount. So, let's say it be up to the principal up to the 65% of your value of the home. The other standalone product is once you've paid off your mortgage. Let's say your home value is 100K, $100,000. The bank will still provide you a home equity line of credit without a mortgage, maybe up to 65% value of the house. So up to $65,000 you have available in HELOC. The revolving portion of the HELOC, there is no fixed term. You pay for the interest that you use, whereas on the mortgage it is fixed and it is amortized over 20 or 30 years, depending on the option that you option that you pick. Now, Appy, we've talked a little bit about HELOC and given the viewers some understanding. Would you be able to walk the users through a live example with numbers, and so as to illustrate how do they use a HELOC, what are the benefits, etc.?
Yeah, let's do that. Before we walk into an example, we'd say that the credit limit on a home equity line of credit combined with a mortgage can be a maximum of 65% of your home purchase price or the market value of the house. So the amount of credit available in your home equity line of credit will go up as you pay down the principal amount in your mortgage. So let's take a look at an example, and this is just for illustrative purposes. Say you purchase a home for $400,000 and made an $80,000 down payment. Your mortgage balance owing at this amount is $400,000 minus $80,000, which is $320,000. The credit limit on your home equity line of credit will be fixed at a maximum of 65% of the purchase price, which was $400,000 or $260,000. Now let's just assume that the $400,000 was your purchase price and the actual price of the house or the market value has gone up by 25% to $500,000. In this case, you would qualify for a higher home equity line of credit depending on what the market price is. So that's also a key component to keep in mind. Now, mind you, this example assumes a 4% interest on your mortgage over a 25-year amortization period. So amounts are based on the end of each year. So if you look at this figure, it shows that as you make regular payments and your mortgage balance goes down, the equity in your home increases. Equity is the part of your home that you've paid down through your down payments and regular payments of principal. As your equity increases, the amount you can borrow also increase, and your ownership in the house also increases because now you own more of the house and the bank actually owns less of the house. Credit limit on your home equity line of credit might be a little less to begin with because you've just paid a 20% down payment on the house or a 25% down payment and you are not getting a lot of credit limit. But remember that every single payment you make, your credit limit increases. And then at a certain point of time, when you are confident that your house price has actually increased in value, you might go for a valuation with the bank, and this way also your credit limit can increase and you're not only dependent on principal payments.
Yeah. So that's great, Appy, and that thanks for that. That probably helps all our viewers gives a better illustration of the home equity line of credit and how to best use it. It is like Appy mentioned, it is going to be smaller because it is against the principal that you paid and not the mortgage amount that you've been paying. Because initially your mortgage amounts would be 50% principal and 50% interest. So thanks a lot, viewers, for tuning in. This was our episode on the HELOC, and it's a wrap. Please share your comments, thoughts, or feedback on how you enjoyed this episode, and if you'd like any further insights on or further examples on any other certain scenarios, we'd be happy to go through them. So thanks a lot, friends, and hope you all tune into our next episode.
Thank you so much.